these firms are starting to take on more debt, often in the forms of these kind of off-balance sheet SPVs, which are a little concerning. And then you mentioned at the very beginning, kind of the circularity around the cross holdings of firms investing in other firms to invest in other firms to buy the chips, which is, of course, something we saw in the dot-com boom, which was, indicative of shenanigans.
I'm your host, Melanie Schaefer. Welcome to Lead Lag Live. Now, AI stocks are riding a seismic shift in capital flows. Nvidia alone cinched a $100 billion deal with OpenAI, sending markets into overdrive. Multiply that by the cascading ripple effects through infrastructure, software, and chip makers, and what felt like hype is now shaping multi-trillion-dollar valuations. My guest today is Kai Wu, founder and CIO of Sparkline Capital. Sparkline Capital is an investment management firm applying a cutting-edge machine learning and computing to uncover alpha in large, unstructured data sets. Kai, thank you so much for joining me today.
It's great to be here.
So let's start with the big picture. The hyperscalers are plowing through hundreds of billions into AI infrastructure. What do you think these capital flows tell you about where the next leg of the opportunity could lie, and what risks are you watching?
Yeah, I mean, this is something I'm watching very closely. As we all know, over the past 10, 15, maybe 20 years, the entire stock market has been driven by the performance of the so-called Magnificent Seven stocks. Google, Apple, Nvidia, Microsoft, these guys. Really their success has been, at least to me, on the back of their business models being in kind of asset-light sectors, right? So I think of Google Search as this perfect business that just throws off cash and doesn't require too much capital to keep afloat. My research is primarily in the field of intangible assets. I'm trying to understand how items like brand equity, network effects, human capital, and intellectual property allow firms like these Magnificent Seven to earn supernormal profits. And, for a long time, these companies have really been the poster child of asset-light business models, being able to just really dominate in terms of, earnings and profitability. And hence, the share prices have followed. And to a large extent, they've become a significant component of the stock market, right? I think about a third or more now of the S&P 500 is now, held up just by these seven stocks. And so what I've been watching closely is this transition away from the model that's made them so successful, right? What we've seen is these companies now set to invest, trillions of dollars into AI data centers. And that's, these physical infrastructure required to power AI models, primarily GPUs and chips, but also the, physical data centers and, power and all this other infrastructure. What we find is, think of like the best example might be Meta. Right. So Meta, of course, the former Facebook social network, very asset-light business. They are now putting about 35% of revenues into physical capital expenditures. Right. And that basically puts them in line with the average utility. So we're now seeing these formerly asset-light companies transition into a more kind of asset-heavy, utility-like model. And I think that's concerning for a few reasons. I think the first is simply the fact that if you look over the history of stock returns, you'll find that the asset-heavy companies have generally underperformed asset-light companies. And these stocks are, again, holding up the stock market and, are trading at valuations that are still reflecting their former glory. And I think the second concern is around the delta, right? The growth in capital spending. And we can probably get into this later, but I mean, if you study the history of capital booms, going back to the dot-com boom, the railroads, any big infrastructure build out around technology, it doesn't always end well for the folks building out the pipes.
Yeah, so that's what I wanted to ask you about next. The AI cycle is sort of echoing past capital cycles. Where do you see parallels today between this AI CapEx wave and earlier booms, like, as you mentioned, the dot-com, and where do you think the differences lie?
Yeah, so I guess on the similarity side, we're seeing a small group of concentrated players, in this case, the hyperscalers, really drive the build out, right? We saw the telecom firms do the same with the internet. And, of course, there's a cadre of companies that were laying out the tracks for the railroad boom, over 100 years ago. And so I think that there's that similarity. I think the differences, are primarily on the balance sheet side, right? So think of like Global Crossing as being perhaps a good example in the dot-com era of a company that, was over-levered and, went bankrupt. And I think a lot of the railroads as well went bankrupt because of the way they are financed and they didn't really have existing cash flows. The difference, of course, is that the Magnificent Seven are, as I mentioned, supremely profitable businesses with, up until today, sterling balance sheets. Now, this is starting to change, right? Where there are indications that, these firms are starting to take on more debt, often in the forms of these kind of off-balance sheet SPVs, which are a little concerning. And then you mentioned in the very beginning, kind of the circularity around the cross holdings of firms investing in other firms to invest in other firms to buy the ships, which is, of course, something we saw in the dot-com boom, which was, indicative of shenanigans. So, I think we're coming from a better starting point for sure with these companies. And I don't think anyone is forecasting that, Google is going to go bankrupt, because of over investing in AI infrastructure. But I think the concern is more around, just the dilution of their business model, right? If you're averaging something that's very profitable and something that's like not that profitable, you're not, ending up in as good a place as you started off. And just around the risks, given market concentration, around, how much is relying on this one, this handful of companies and more importantly, the one theme of AI. When AI does well, the economy does well. And when AI does poorly, the economy will do poorly. And so I think that is definitely an area of concern today.
Yeah. And academic research often shows as well, like firms with very high asset growth underperform. What does that tell us about pulling back the hood on growth today? And how do classic signals fail in this environment?
Yeah, no, I'm glad you brought this up. My background is as more a quant researcher kind of, and a lot of the work I've done, especially earlier in my career was studying a lot of the factor literature. So think of things like value, momentum, quality, and the characteristics of companies that lead them to succeed on average and not. So there's a factor, in kind of the, main models that people use called the investment factor, which I find is kind of a confusing name, but so I think it's better termed the asset growth factor. And what that shows is that companies that on a trailing 12-month basis, in percentage terms, grow their assets, so grow their balance sheet, more than average, tend to subsequently underperform. Right, and this is a pretty robust finding across markets and across time. And more importantly, it's not just about technology. Right. Of course, investment cycles can be, tech-led, where an innovation like AI or the internet comes around and everyone wants to hop in. But it can be as mundane as, cod fishing, or you can think of examples in banking with the financial crisis and housing. Right. That's just the idea of, the capital cycle. People kind of invest too much and then realize subpar returns. What's interesting with this factor is I've actually been doing a bit more work on it, trying to disentangle the different components, because firms, when they increase their balance sheet, they can be doing so to accomplish a couple of different goals. The most important being, are they spending the money on building a physical infrastructure or simply on R&D, marketing, and perhaps creating other, more intangible assets? And one thing you find is that it's really the physical CapEx that is most linked to the underperformance. And I think that has to do with just the long-lived nature of a lot of this this infrastructure, right? Like, these things, semiconductors, for example, which is, of course, what we're talking about to some extent, is a notoriously cyclical industry, where if you look over the past few decades, you'll find these big booms and busts because, companies see good times, they over forecast demand, they then overbuild. It takes a few years for the supply to come online. It comes online, they've overbuilt, there's a collapse, and so on and so forth, right? And so this is just a history that we've seen in these kind of capital intensive industries. It's, I think, linked largely to what the academics find as well with regards to the underperformance of these stocks on average. The other thing you can do is you can disentangle this asset growth anomaly into two dimensions. So one is like the effect of just a macro, which is, you have these waves of investment, both across the market, like we did with the .com, but even within the individual sectors, like through airlines, let's say, and then there's consolidation and expansion. And then also within each industry at the company level. what you find is that the effect persists on both levels. So both a macro effect, where when an industry experiences a lot of capital inflows, they tend to underperform, as well as when individual companies experience, aggressive ramp up in their capital expenditures relative to their peers. Those companies also tend to underperform. And again, like these findings by the academics are not meant to be indicative of any one company. Like, we're not specifically picking on Meta in this case, but just is a kind of average finding across thousands of companies through time, just saying, hey, this tends to not work out that well if applied kind of, if you were a betting man, right, and wanted to apply it kind of consistently across names.
What does this then potentially mean for the stock market as a whole? I mean, like, we see extreme concentration with a handful of mega cap tech names carrying the market. Do you view that as a new AI risk factor? And how do you manage concentration risk in your own framework?
Yeah, I mean, I think, look, anyone investing in stocks is generally using as a starting point a cap-weighted index, right? So they're going to be buying stocks in proportion to their market caps. And of course, the Magnificent Seven stocks have become so big that they comprise, as I mentioned, over a third of the index. Right. So right off the bat, you already, have your fate in the hands of this idea. And then, of course, there is exposure just at the economic level to AI. Right. I think some people have estimated that about half of the GDP growth of the US last year was due to investment in AI. Right. Because that's, of course, a component. Private sector investment is a big component of AI. And then there's, of course, like the labor market impacts and so forth of the technology. And so to the extent where, investors are already concentrated in the Magnificent Seven by dint of their exposure to indices, my thought as an investor would be, try to find ways to diversify. Like, maybe AI will end up becoming the real deal, and we will end up seeing this, a revolution in the way the world works. And I do think so. But as we've seen in past cycles, oftentimes that can take a long time, right? Like with the internet, the adoption curve was very long. It took decades, right, for the S curve to fully materialize. And in the interim, there were plenty of periods, such as the dot-com bust in 2002, where stocks, investors were disillusioned and stock prices, troughed. So I think, as investors, you want to be, pretty cautious with regards to exposure to any one theme. And, while, even 4 or 5 years ago, when I was, first doing research on this topic, I was very bullish on AI, saying, look, this is the real deal. We should all just kind of be doing AI. Most folks I know are underexposed to AI. I think it's now flipped where, fast forward 4 or 5 years, ChatGPT is now released. Everyone's talking about AI. I think the risks are actually now the opposite, where everyone's now overexposed to AI. And in particular, due to just the cap-weighted indices, favoritism towards the larger stocks. So as an investor, my thought would be to look for ways to invest outside of the Magnificent Seven, outside of these companies that are not only exposed most to AI, but are in fact, exposed most to the kind of picks and shovels, capital expenditure component of AI. If you go back to the dot-com and railroad booms, the folks who actually built out the railroads, the folks who actually built out the telecoms, those guys did really poorly. Now there are some firms that did well off those booms, but the guys who actually built all the physical infrastructure in both cases did not do well, right? And so I think that's in particular kind of the epicenter of risk for the AI boom. That, look, the AI may continue to be transformative and may ultimately be adopted, by enterprise and by consumers. In which case, there will be many beneficiaries, and also might not. But even if AI, disappoints, in the investments that these companies are making in data centers underwhelm, that's actually almost better for the adopters, right? Like, when the dot-com bust happened and fiber collapsed, and was unused for a long time, companies could then, like Netflix, for example, could then utilize that fiber at below cost in a subsidized way to build other businesses. And so I'd say, focus more on the beneficiaries of AI as opposed to the picks and shovels. I think that's probably a slightly safer way to deal with the the consolidation of risk around this single theme in the current market.
So to just get in a little more deeply into this, could you walk investors through how they could position themselves through the full tech adoption cycle if that comes to?
Yeah, I think the best way to think about this is, by analogy to the dot-com boom, because we actually have a full cycle of history. We can kind of say, hey, at least with hindsight, how would I have done that? So basically with the dot-com boom, you kind of saw the adoption of the internet unfold in waves, right? Whereas in the very beginning, the say mid 90s, early 90s, mid 90s, there was a lot of the innovation was just by, these kind of pure tech companies, these pure play internet names, AOL, Cisco, those would have been the best investments. But what happened was everyone figured that out. And, these stocks are now trading at, price to sales ratios above 30. And I use price to sales because in some cases, these companies were not even profitable. So fantastic valuations. Everyone was betting on the, new economy, and these companies got bid up. So what would have then been the right play, again, with hindsight, would have been to then rotate into phase 2 of the game plan, which is to not buy the innovators, but to buy the early adopters, right? So early adopters in this case, I mean companies that were positioned to benefit from the usage of the internet in their own business lines, but weren't necessarily kind of pure play internet names. They're not, telecoms or .com companies. Those companies were still trading at relatively affordable multiples, not too different from the market in general, yet still had a lot of upside from the further adoption of the internet, right? And then from there, once those names got bid up, you kind of went on to kind of more mainstream companies that, again, we all got a GDP bump from from the internet, and those guys would have been kind of the third stage, right? So you can kind of see how this plays out. As adoption goes, you want to kind of always be moving, right? If you only bought AOL, you would have done really well in the beginning and then done really poorly and end up, losing money, right? So I think the key here is to be dynamic and to be value conscious, because valuations in a way kind of help you organically navigate the cycle. It helps you kind of determine, hey, when am I starting to get to the point where, we go from phase 1 to phase 2, right? So they're going to help you naturally do that. And that's how one would have done the first cycle. I think in AI, we are, at least in my mind, starting to reach the tipping point between phase 1 and phase 2, where Nvidia is, at this point, everyone knows it's an AI stock, right? It's no secret anymore. If you bought it 5 years ago, you were probably ahead of the curve. You're no longer ahead of the curve by doing that. And, to a large extent, both the upside and downside of AI continuing to outperform or underperform is currently kind of correctly priced into Nvidia. And so if you really want to profit from the continuance of AI, you want to look for the next wave of guys, the kind of early adopter category. So that's kind of where I see us currently positioned. But again, like, who knows, it could take longer or shorter to play out than in past cycles. History only, rhymes, doesn't repeat.
Yeah, and I think that's some really great advice and reminders for investors. Just lastly, Clive, for viewers who want to learn more about your work and even connect with you, what's the best way to do that, and where can they go to learn more?
Sure. Yeah, I have a website, sparklinecapital.com, and I post a bunch of different research papers, including some of the research that I've alluded to on this talk. And then in addition, you can just reach out to me directly on social media. I'm on both Twitter and LinkedIn under the handle CKaiwu, CKAIWU.
Okay, thanks again for joining me, and thanks to everyone for watching. Be sure to like, share, and subscribe for more episodes of Lead Lag Live.